Imagine looking back on your life and realizing that the biggest financial mistakes you made, they weren't bad investments. They were emotional decisions. Buying things a little too soon, waiting way too long to invest, or chasing those big wins that just never came. You know, most people don't lose money because the market is unpredictable. They lose it because they follow fear or excitement or pressure instead of a plan. Today, we're going to break down the real financial behaviors that quietly destroy wealth and the simple habits that protect your future, no matter where you're starting from. Welcome to Invest Education Hub, where we turn painful money lessons into practical strategies that anyone can use to grow smarter and more confident with their finances.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
Okay, let's just dive right into this because we're going to start by confronting some uncomfortably familiar moments. Take this first one. You land your first real job, you're finally making a decent salary, and you think, I've made it. I need a car that shows it. I have heard this exact story 100 times. I know one guy, he had a perfectly fine, paid-for truck, but he went out and financed a brand new Acura at a 9.25% interest rate. That car payment, which felt like this big symbol of success, was actually just a wealth vampire, sucking away money that could have been compounding for his future. That feeling of wanting more than you're really ready for, it's such a common trap. Or how about this one? Picture this. It's the late 90s. The internet is absolutely booming. And there's this new internet fund that just feels like a can't-miss opportunity. So you put in a couple $1,000 and boom, it doubles. Just like that. You feel like an absolute genius. You're telling all your friends. But then the bubble bursts, and that $5,000 turns into $375. It's just so easy to get swept up in the hype, thinking you found some kind of secret shortcut to wealth, but chasing the next big thing is usually just a shortcut to losing your shirt. And then there's this one, the one that feels the most responsible, the most logical. The market looks a little too high, or maybe you think a recession is just around the corner, so you just wait. You build up cash in your savings account and you tell yourself, I'll jump in when things calm down. This hesitation, it feels like the safe, smart choice, doesn't it? But as we're about to find out, it can be one of the most expensive financial decisions you ever make. So here's our game plan. We've structured this to totally reframe your relationship with money. We're going to start with your biggest enemy, which, spoiler alert, is your own psychology. Then we'll move on to building a financial fortress, uncovering the super boring but effective path to wealth, exposing those seductive traps, and we'll end with the one mistake you absolutely cannot afford to make. All right, section 1. The crucial point is this. Most of the financial pain people experience, the real lasting kind of pain, it's not caused by market crashes or bad economies. Nope. It's caused by our own predictable, emotional, and very, very human behaviors. And what's so fascinating here is how our brains disguise these emotional reactions as logical decisions. I'll start later sounds responsible, right? But what it really is fear of starting. I'll wait until things calm down, feels so prudent, but it's really just fear of uncertainty. And oh, the most dangerous one. Everyone is getting rich from this, I've got to get in. That feels like seizing an opportunity, but it is pure, uncut fear of missing out, FOMO. This right here is where financial self-sabotage begins. And let me tell you, fear is incredibly expensive. It convinces you that a savings account earning next to nothing is safe, while inflation is just silently eating away at your money's buying power. Even worse, fear is that little voice inside your head that screams, sell, at the absolute bottom of a market dip, which is the perfect way to lock in your losses. It leads to this classic wealth-destroying cycle. You stop investing when things look scary, and you only jump back in when all the assets are already expensive and everybody feels confident again. This all comes down to the siren song of market timing. We all want to believe that we can outsmart the market, right? That we can get in at the very bottom and sell at the very top. But the evidence, my friends, is overwhelmingly clear. Trying to time the market is a losing game. It replaces a sound strategy with pure guesswork. You stop being an investor and you start being a gambler. It's a total trap. Okay, let's move on. Section 2. Before you can even think about growing your wealth, before you can think about going on offense, you have to build a fortress. You need a solid foundation that protects you from all of life's inevitable curveballs and, just as importantly, protects you from your own emotional weak spots. Okay, think about this for a second. Really let it sink in. The S&P 500, which is a fantastic long-term investment, historically returns about 8% a year on average. That's a great return, right? Some years are up, some are down. But if you have credit card debt at 20% interest, paying that off isn't an investment that might make you 20%. It is a guaranteed, risk-free 20% return on your money. It's not sexy, I get it, but clearing high-interest debt is the single highest return, lowest risk move you can possibly make. It's the first brick in your fortress. Next up, your emergency fund. And please hear me on this. This is not an investment. It is insurance. It's the cash buffer that prevents a job loss or a surprise medical bill from turning into a full-blown catastrophe that forces you to sell your real investments at the worst possible time. Just follow these 3 simple steps. Figure out your bare-bones living costs, put that money in a separate account so you're not tempted to touch it, and then automate the savings. This is your peace of mind fund. Okay, with your debts being managed and your emergency fund in place, your defenses are set. Now it's time to go on offense. Your money needs a job to do, a place where it can actually work for you. This means opening an investment account. A standard brokerage account is your flexible gateway to buying stocks and funds. And retirement accounts like a 401k from your job or a Roth IRA that you open yourself, they offer powerful tax advantages for that sweet, sweet long-term growth. And hey, if you're sitting there thinking, okay, that sounds great, but where do I even start with all this? Don't worry. We've got guides and tools over at Invest Education Hub that can walk you through choosing the right account for your goals. It's a huge step, and we're here to help you get it right. All right, section 3. Now for the part that isn't glamorous. It's not going to make for exciting dinner party conversation, but it is incredibly, undeniably powerful. We're talking about the slow, the steady, and the frankly boring strategy that actually works. This quote just nails it, doesn't it? It perfectly captures this paradox of being too cautious. That fear of a temporary loss often leads to the permanent loss of opportunity. While you're sitting on the sidelines waiting for that perfect moment, the market is usually just chugging along without you. The cost of trying to avoid risk is so often far, far greater than the risk itself. Take a look at this timeline. It's basically a highlight reel of financial panic from the last decade or so. Now just imagine for a second that you are the world's unluckiest investor. Your strategy is to save up a bunch of cash and only invest a lump sum right before every single one of these downturns. So you invest at the peak in 2011, you do it again in 2018, and again right before the COVID crash in 2020. Sounds like a total disaster, right? Wrong. Even that investor, with the absolute worst timing imaginable, still ended up with a huge portfolio over the long term simply because they stayed in the game. You don't have to be right all the time, you just have to be in. So what's the secret weapon to combat our own flawed timing instincts? It's called dollar cost averaging. The concept is beautifully simple. You invest a fixed amount of money on a fixed schedule, say $500 on the first of every month, no matter what the market is doing. When the market's high, your money buys fewer shares. When it's low and on sale, that same $500 buys more shares. By automating the whole process, you take fear and greed right out of the equation. You're just always buying. And what are you buying with this automated system? Well, instead of trying to find the one winning stock, the needle in the haystack, successful long-term investors just buy the whole haystack. They do this through broad index funds, like an S&P 500 ETF. With a single purchase, you own a tiny little piece of the 500 largest companies in the US. It gives you instant diversification, and it prevents you from making a catastrophic bet on just one company. Okay, let's talk about the shortcuts. The get-rich-quick schemes that promise you massive returns, but let's be honest, almost always lead to massive losses. These are not investments. These are seductive traps. People who feel like they're behind often think they can catch up by taking on these enormous risks. This is where you see people piling into things like options, penny stocks, or whatever crypto coin is hot this week. These are not investing strategies. They are gambles with life-altering consequences. We saw it with the internet fund story, and we saw it with the story about traders who were right that Netflix was overvalued, but their options expired 2 months too early and they lost everything. Their analysis was spot on, but their timing was off, and in the world of high-risk gambles, that's all that matters. And this quote right here from an investor who is trading options on Apple stock, man, it highlights a crucial, brutal truth. One big loss can, and often does, destroy 10 wins. That initial success feels incredible. It makes you feel invincible. It encourages you to take the next, even bigger risk. And that's usually when the floor just falls out from under you, wiping out all your gains, and then some. This is a lottery ticket mindset applied to your entire life savings. It's this seductive belief that you're just one Hail Mary pass away from solving all your financial problems. But real, sustainable wealth isn't built on luck.
It's built on a foundation of consistent, boring, intelligent decisions that you repeat over and over again for decades. And this brings us to our final, and honestly, our most critical section. We've talked about small mistakes and seductive gambles. Now we need to talk about the one mistake you must avoid at all costs, especially as you get closer to your financial goals. We're talking about the kind of mistake where there is no coming back.
This is such a crucial distinction to make. Early in your career, your biggest financial asset isn't your bank account, it's time. You have decades of earning potential ahead of you to recover from a mistake. But later in life, that dynamic completely flips. Your biggest asset becomes the foundation you've spent decades carefully building. And losing that isn't just a stumble, it's like falling off a cliff with no safety net. The risk is no longer just losing money, it's losing the future you worked your entire life to secure. Let me tell you a story that perfectly illustrates this terrifying risk. There was this incredibly successful real estate developer. He owned an 8-figure portfolio of commercial buildings. All of it paid off, completely debt-free. He had already won the financial game. But his son had this big idea for a new development. And to get the capital, the father agreed to put his entire debt-free portfolio up as collateral. They thought it was a sure thing. I mean, the community was growing, everything was looking up. And then 2008 happened. The financial crisis hit, the project went completely belly up, and the bank foreclosed on everything. An entire lifetime of work, an entire empire was wiped out by one single, massive, and completely unnecessary risk. He didn't need to take that bet. He had already won. The final lesson is this, and it's probably the most important one we'll talk about today. Never risk what you have and need for something you don't have and don't need. Real, lasting wealth is built from thousands of small, boring, disciplined decisions, not one single, dramatic, all-or-nothing bet. So let's bring it all together. This slide just lays it out so perfectly, the two paths you can take. On the left, you've got the wealth destroyers, trying to time the market, making emotional trades, taking crazy risks, speculating, and making panic decisions. And on the right, you have these simple, effective wealth builders, prioritizing time in the market, automating your investing to take emotion out of it, taking appropriate risks, using broad index funds, and most importantly, following a strategy instead of your feelings. The path to financial success isn't about being perfect. It's about consistently avoiding the stuff on the left and just embracing the boring but it works principles on the right. Building wealth isn't about being perfect. It's about avoiding the traps that keep most people financially stuck. If this helped you understand how small decisions can shape your entire financial future, do me a favor and hit like, subscribe, and share it with someone who needs to hear this message today. Here at Invest Education Hub, we help you make clear, confident money decisions that protect your future and unlock long-term growth. So, let that question sink in for a minute. Knowing what you know now, what is the one financial behavior you will change starting today? Will you finally set up that automated investment? Will you commit to paying down that high-interest debt? Will you just stop checking your portfolio every single day? The most powerful changes start with a single conscious decision. Thanks for watching.